So started slowly building a good investor database, and now I think we have about 135 investors who have maybe invested, I think it's a little over $11 million with us.
Arn, welcome to the podcast.
Hey, Drew. Great to be here. Thanks for inviting me, and looking forward to having a nice chat with you about real estate investing.
Yes, sir. Yeah, no, we're totally pumped to dig more into kind of your backstory and learning more about how you got started, diving slowly into your syndication route, and learning more about what we can do to get involved. So starting there, prior to real estate investing, kind of where did life start out for you?
Well, life started out in Marysville, California, where I was born. My dad and my uncle ran a dairy farm, rice farm, but family legend has it my mom didn't like the farm life, so we moved to the San Francisco Bay Area. Kind of a typical middle-income American life. Was taught to do well in school, work hard, get a degree, et cetera, et cetera. So I kind of all did that. Ended up with a master's degree in chemistry from the University of Michigan. And then I kind of decided, well, maybe the academic life really isn't for me, and I wanted to return to the Bay Area. So I called my dad and said, hey, Dad, I want to come back. And he had a residential brokerage business in Menlo Park, California, which is right next to Palo Alto, where Stanford is. And so I packed my bags, went out, got my real estate license March 1978, got into residential brokerage. No grand plan, just kind of happened, and I've been in real estate ever since.
Awesome. And when you were kind of getting initially started from your daytime with the brokerage, when did you kind of start drifting off and kind of investing in some things yourself?
Great question. So like many people, I think, you buy your first house. And so I bought my first house, 1980, little townhouse, right up against Bayshore Freeway and kind of a rougher area on the peninsula. Like many people, they don't buy into the executive area their first time out of the gate. You buy what you can, you buy what you can afford, and you build up from there. So paid 11 3/4 for my first mortgage. So when I see interest rates 6, 7, I don't lose my mind. I know they were 2.5 or 3, but on my first house, I paid 11 3/4. Was married at the time. We lived there about 6 years. And as often happens, you start making more money. My brokerage business was going. So we could afford to move to a better location and a bigger house. So instead of selling my first house, I kept it as a rental. So that was my first rental. And I think that's a story that is repeated very often. People buy that starter home. They have the foresight to understand, hey, if I can hold on to this and still move to a bigger home, I'm going to be advantageous to that. And so that's what I did. So my first house I lived in became my first rental property. My father was a real estate broker, but he was also an investor. And back in those days, this would have been late 70s through the 80s, you could actually buy houses in the San Francisco Bay Area that made sense as rent. Today, the average price is $2 million. It's hard to make sense as rental, but back then they may have been $200,000, and you could actually make them pencil. So as my brokerage business grew, and I was in Menlo Park, basically the same location, 35 years. So I developed a good referral business, had a nice income and so on and so forth. So I used that capital to invested in the Bay Area. And then in 2000 or so, I started investing in Austin, Texas, which was fortuitous choice by myself, and did very well there. So I just kind of built a single family portfolio. And for me, it was a little bit easier. I didn't have a 9-to-5 job. I wasn't tied to a desk. I didn't have to be any location. I was out meeting buyers. I was out meeting sellers. meeting contractors to fix houses up, meeting contractors to get bids. And so kind of managing a rental portfolio was just all part of my normal day, as opposed to somebody who's got 3 meetings from 9 to 5 and, has to be at his desk or her desk. So it was a little easier for me to manage the portfolio than maybe some typical corporate employees who are well paid, but they work a lot of hours and it's a high demand job.
For sure. And those are some good things to touch on. So to that point, how much of your portfolio initially was managed by you? And then at what point was kind of a turning point that you kind of started to look for your next steps?
Yeah. So what I generally did was rental properties in my area, I self-managed. And then, of course, the ones in Austin, Texas, I hired. I kind of bought in 2 different areas. So I had 2 different property managers, kind of the suburbs of Austin, north of Austin. So if they were local, I managed them. If they were out of state or out of area, I'd have third-party property management. And then when I moved to Greenville, South Carolina, about 10 years ago, I continued with the single-family investing, and I was also self-managing. But I happened to, by chance, through the real estate network, through the local real estate network, I met a guy, Brian, who is a property manager, and I actually kind of bought a duplex off him. And we developed a friendship, and slowly I turned over my Greenville rentals to him. And in retrospect, I should have done that years ago. Property management isn't easy. It can take time. You kind of got to do it at scale. You kind of got to have systems and processes to really make it work. I did okay, but maybe I wasn't as aggressive in terms of increasing rent and so forth. And maybe I had more of a personal relationship with the tenants. Not that that's any problem. I mean, I basically bought these properties for the appreciation and the equity growth. But let's just say I wasn't an A-plus property manager, and it's time consuming. And so when I turned it over to Brian, it was kind of like an aha moment. I should have done it years ago. It frees up time. They run it more efficiently. And part of that's just ego. Maybe you always kind of think, well, nobody can do it any better than me. But of course, that's often wrong. Each of us has particular skill sets. And I think the key to really getting ahead and succeeding in our capitalist society is playing to your strengths and trying to maximize your strengths and abilities, and then find partners who have different skill sets, and then by combining them, you really create a really strong team, right? It's like the quarterback can't play offensive line, the running back's not going to play wide receiver, so there's skills that are needed, and putting these skills together really creates an effective team, and that certainly applies to investing. So I was a little slow on the uptake there, but I'm glad I did it. And actually now he's my primary partner in multifamily. He does a great job running the assets. I do what I do, which is find deals, talk to investors, see the big picture. Knowing, like when you ask people to invest their capital with you, you have to have some degree of confidence that you can do a good job for them. There's kind of a standard of competence, a fiduciary duty, and I can do that with clear mind, knowing my partner, Brian, really knows how to run the assets. So that's how I kind of moved away from self-manage into third-party property management.
For sure. And some of that team development, did that come from a need for capital, or were all of these initial assets kind of a pool from the beginning?
Well, the original single family portfolio I put together, that was basically my own capital. Though I would say over the years, maybe a friend or two and I would go in and buy a rental. But generally, the kind of single family 2 to 4 units was my own capital. And when I decided to make the move to multifamily, the first building I bought was a 12-unit building. And on that one, I actually brought in some partners, 4 local friends. We had done a few flips together. And again, I think this is, a typical story. Be careful who you partner with. Start slow. Do 1 or 2 deals. Don't get married. You're just dating. Do 1 or 2 deals and see if it actually works. Do you like working together? Does everybody do what they say? Does everybody come through and carry their own oar or paddle their own oar, however you want to say it? So on the first 12-unit deal, brought in 4 local friends here from Greenville, and we bought these 12 units. And that was kind of the start. And then from there, I went to 43 to 30, and 2 years ago went up to 281. With my current team, which is Brian Walsh, who's in Greenville, runs the operation. Then we brought in another guy, Dan Raleigh, who had invested with us as an LP on 3 or 4 deals. He lives in Cary, North Carolina. And interestingly enough, he's a Bay Area expat too. And he had a career in corporate world as a CFO, COO. So we eventually brought him into the team because Brian and I are real estate schmoes. That's what we do, right? We've done it a long time. Dan has kind of more that analytical financial mind. And so he was, again, another piece. So we now have kind of a 3-man team, and we each have our own areas of expertise. But those partnerships were developed over a period of 3 or 4 years, starting slowly, getting to know each other, making sure you're compatible. And so for people looking for partners, and it's an important part of the real estate investing business, just go slow, kind of test it a little bit. And if it works, then you can start to scale.
To that exact person who might be in that image today, right? The capital's the personal capital is kind of becoming limited. They're looking to grow those partnerships. What are some partnership or investment routes that they have available to them to kind of take that next step forward?
Yeah. So, yes, I've done well in real estate, but I run out of capital. I find things I want to buy, and sorry, I don't have 500,000 liquid around to buy it. So the partnership aspect is a way to get into better, larger deals that hopefully are more lucrative. And of course, with the larger deals, you kind of have more professional operation. You have economies of scale, so a lot of it makes sense. So the 2 main ways I would say to partner would either be joint venture, and that's kind of maybe where 3, 4, 5 people get together and maybe they each put in 25, 50,000. Just kind of depends what arena you're playing in. But you have 3 or 4 people, 5 people go together. They all put in capital. They share the profits in proportion to the capital they put in. So if everybody puts in a quarter, they get a quarter of the profit. And typically with joint ventures, again, you try to have roles and responsibilities delineated. So one of the members maybe takes care of the property management. The other member maybe takes care of the financials. The other one finds them. And so everybody should theoretically be involved in the operation of the property. And joint ventures work good for smaller real estate deals, because the other option is to go to syndications, and those are kind of more regulated by the Securities and Exchange Commission, and there's greater legal expense involved in setting up the structure to comply with the regulations of the law. So typically joint venture or syndication. And of course, there are REITs, which are more stock, where you buy stock in a company that owns real estate. It typically doesn't have the same tax advantages of kind of direct ownership of real estate in terms of depreciation and tax deductions. Not saying anything against REITs. They're a little more liquid. You can buy, sell in a day. Joint ventures and syndications, they're real estate. You don't turn around and sell it 2 hours after you wake up in the morning deciding to sell, which actually could be a positive trade of real estate. As we note, the stock market had a big drop, I forget, about 10 days ago. And I'm old enough to kind of know it's likely to bounce back, and so I'm not going to panic to sell. But perhaps less experienced investors would get a little nervous, and they log on to their Charles Schwab account and hit sell. And then, of course, the next day the market drops back, jumps back 500, and they're going, why did I sell? Where with real estate, it takes longer to do transactions, so it allows the emotion to recede a little bit, and so you can maybe perhaps be a little more rational about your decisions.
For sure. And just while we have your time today, I want to make sure we get a chance to really detail out the two major ones you mentioned for, again, someone to move forward with, be the joint venture and the syndication. Can you structurally lay out, just from a basic level, the structural difference between the joint venture and the syndication?
Okay, so let me start with the syndication, because it might be a little easier to then contrast it with a joint venture. In a syndication, there are generally two parties. There'd be the limited partner investors. These are the people who put the capital into the deal. It could be in chunks of $25, $50, $75, $100,000, just kind of depends. So the limited partner investors, they invest their capital. They don't have to sign on the loan. They have no obligation for repayment of the loan. They have no responsibilities for the day-to-day operation of the property. They never hear if a toilet clogs or a tree fell through the building. They're not involved in the day-to-day minutia. In addition, they don't have any real control on the investment, because it's the general partners, which is the other party in a syndication, the general partners, who are responsible for running the deal, taking care of the day-to-day operations, signing on the loan, and they make the decision when to sell, when to refinance. So with a limited partner, you're making an investment, but at that point, it then doesn't require any of your time and attention. It's the general partners who do the work of operating the property. And then typically the way the cash flow or the profits of the property are distributed, typically the limited partners will get what's called a preferred return. And this is not a guaranteed return. Nothing in real estate's guaranteed. No investment's guaranteed. If you hear guaranteed, please run the other way, because unless it's a T-bill, it's probably not guaranteed. And even the T-bill is based on the full faith and credit of Uncle Sam. So to date, they've stuck to it, but there's no guarantee in real estate as in any other investment. So the preferred return, what that means is the limited partner investors receive a certain preferred return on their money. And typically in this market today, the limited partner investors get a preferred return of about 7 to 8%. Again, not guaranteed, but what it means is that first 7 or 8% the property generates goes to the limited partners, And if that's all the property does, the general partners who run the asset don't receive any of the profit. Then above the preferred return, there's what's called a promote, also known as a split. And generally what these are is the limited partner investor will get between 70 and 80% of the profit. That's profit upon sale. That's 70 to 80% of the cash flow above pref. The general partner will get 20 to 30% of the profit upon sale. And so if the deal does very well, the general partners will be highly compensated for the performance. But of course, let's not forget the limited partner investors who didn't really have to deal with all the headaches are ending up with 70 to 80%. And let's not forget they get the first 7 or 8% annual return off the top, and then the balance is split. So essentially, if the general partners do well, run the property well, and it's a profitable investment, the limited partners do very well with no hassle. The general partners are well compensated. On the other hand, if the investment doesn't make much of a return, the general partners have basically worked for zero money. So the syndication is a great way to go for people who are busy in their career, maybe family, church, community. Life's hectic. We all know that. We're running around. And I think most people understand real estate is a good asset to own, and owning real estate ultimately will prove to be a benefit to them and their family, but either they don't have the time or the expertise or just the desire to deal with the day-to-day of a clogged toilet or a broken hot water heater. So the syndication investment's a good way for people to benefit from real estate without having some of the potential hassles. So that's kind of a syndication. A joint venture, there's no general partner, there's no limited partner. There are members in the joint venture, and their ownership and their share of the profit is generally strictly a function of how much money they put in. So if you needed to raise $500,000 to buy this one property, and investor A put in $200,000, they'd own 40% of the deal. Investor B, who put in $100,000, would own 100 divided by 500, 20% of the deal. And then typically, again, all the members should have some active involvement in the running of the deal. So it's maybe not quite as hands-off as a syndication. And I do both, just kind of depending on how big the property is, what's kind of the performance profile of the property, because certain properties may set up better for joint ventures, others may set up better for syndications, and it's just kind of on a case-by-case basis that you kind of decide. So hopefully that makes sense, but welcome any follow-up questions.
Yeah, for sure. And just, we have a lot to hit, obviously, again. So we appreciate your time and your openness to talk about all that. But just to kind of detail out some of the last things you mentioned there, what were some of the basic details that would lead you down the joint venture path versus the syndication from a very generalized standpoint?
So from a general partner point of view, the syndication structure is probably a little better for the general partner in terms of compensation, because their compensation is based more on the performance of the deal, the profit of the deal. So, for example, in most of the syndications we do, Dan, Brian, and I, we typically put in between 10 or 15% of the total capital required. So if we need to raise $1 million, we probably put in 150 to 200,000 of our own money and have LP investors put in 800. And then we get a share of the profit if in fact the deal does well. Whereas with the joint venture, say you needed to raise 500,000, and say for me, all my capital was tied up in another deal, and maybe I only had 25 or 50,000 to invest. So now with the joint venture, I'm only going to own 5 to 10% of the deal. And so if you want to say selfishly, I have to make the decision, is it worth me running the deal when I only own 5 to 10% of it, or is it better to kind of do syndication? So that's kind of how the thought process goes in. We love all the deals we do, and as deals cycle through and we get paid off, we have more capital and we can reinvest. So sometimes the decision is just kind of based on how much capital we have on hand at the time, and also the deal size. So I think the other thing is, as the deal gets bigger and you need to raise more capital, it tends to push it more towards the syndications side. So, for example, in June, we closed, say about $6.2 million of acquisition in new duplexes. I think we bought 23 duplexes, 46 units for a little over $6 million. And we ended up raising about $2.9 million. Dan, Brian, and I have done very well, but we don't have $2 million liquid cash sitting around. It's all invested. So that was not a deal we could do as a joint venture. If, on the other hand, we found 6 units for $1 million and it would cost $250 down to buy it, we could probably cobble together 75 each and buy it. So that's kind of the thinking that goes into it. Yeah.
For sure. And I really appreciate that. And kind of just to summarize real quick, it sounds like maybe your first line of check would be, hey, yeah, what's the size of this deal? Is this something that I feel comfortable with myself or with a couple partners handling? And, based off your yes or no there, the next step would be, okay, but now on top of that, we feel comfortable going this direction, but what kind of capital do we have? And so there's kind of a leveled approach to it. It's not just kind of a one checkbox, move on kind of thing.
Correct. And it also, one of the questions that always is faced is, when you're a real estate investor, you're talking to people and you're telling them, you're sharing what you're doing with them, and people will raise their hand and go like, tell me more, or, hey, next time you get a deal, please let me know. And so you're talking to investors and you're kind of gauging interest within your social and professional sphere of who's actually interested in real estate, who's interested in partnering with you. And so maybe you get a sense of how much capital you can raise. But you don't really know until you actually do it, right? So somebody's saying, hey, yeah, I'd like to own a piece of an apartment building, is a long way from somebody writing a $50,000 check and saying, yes, I want to invest. So you kind of got to gauge it. And when we did our first deal, it was about $2.7 million. We needed to raise about $1.4 million. We thought we could raise $1.4 million. We thought we had the connections and the relationships built up and there was enough interest, but we didn't know until we actually did it. So you got to kind of get in and feel it out. And then once you do one or two and you do well by these people, they're more willing to kind of jump in and support the third, fourth, and fifth deal. So we've started slowly building a good investor database. And now I think we have about 135 investors who have maybe invested, I think it's a little over $11 million with us. And this is in, say, about a 3.5 year period, three years, 3 months, something like that. So you build it slowly, you do well, and the proof's in the pudding. People get more comfortable. And to circle it back from the other side, when I'm talking to LP investors, I always tell them, if you got a certain nest egg you can invest, you don't have to go all in on the first deal. Put a little money here, try out 3 or 4 deals. You'll see who performs and who doesn't, and you'll learn, you'll test them, you'll see them in action, and then you can make subsequent investment decisions based on their performance. So you don't have to go all in. And I'd recommend against doing that. I test the waters 3 or 4 different places, kind of diversify, spread your risk, and then see the operators who really perform and who you like.
For sure. And to that point, we're talking about, some people want to dip their toes and kind of get started. Slowly stepping into the route of digging deeper into these LP and GP roles. First off, can anyone invest in a syndication, or are there some other things they need to be aware of before they can really move forward?
Yeah, great question. So, and I think there's a lot of misinformation out there. There's something called an accredited investor. And many people are under the impression only accredited investors can invest in syndications. And the definition of an accredited investor is someone with a net worth of over $1 million, not counting their personal residence. So their personal residence, the equity in the personal residence doesn't count for this accredited investor criteria. So this would be more like equity in other rentals you own, 401k, stocks you own, mutual funds, bonds, et cetera, et cetera. Net worth over $1 million, exclusive of your home, you're accredited. The other way to qualify as an accredited investor is, and I always get these numbers mixed up, but I think it's $250,000 annual income if you're single, $300 if you're married, and maybe it's $200 and $350, but there's some income level and it's right around that $200,000-$300,000 level. So if you make over that income, you're then considered accredited. So there are syndications called 506C as in Charlie. Those are open only to accredited investors. And those can kind of be advertised. Put an ad in the paper, you can blast it on Facebook, you could put it on LinkedIn, invest in 100 units in Tulsa, Oklahoma, accredited investors only. So many operators like doing the 506C because you can kind of broadcast it, but it only applies to accredited investors. The other syndication statute, or whatever you want to call it, is 506B as in boy, and that's open to accredited investors and what the SEC defines as sophisticated investors. And there's maybe no one definition of sophisticated, but the idea is, does the investor have enough financial knowledge and acumen and some prior investing experience, whether it be in real estate or the stock market? Do they have some financial knowledge or sufficient financial knowledge to properly assess the risks and the rewards of any investment? Basically, it just means, are they kind of savvy with their money? The other thing I kind of look at is, how's their credit? If somebody has poor credit, doesn't mean they're a horrible human being, but it just means they probably don't have their financial house in order. And these syndication investments are longer term, 3, 5, 7 years. So you don't invest money you might need in 6 months. This money you put away, you invest 5 to 7, and then it comes back to you. Do they have any savings? What's their employment history? Have they had steady employment? Basically, do they have their financial house in order? Do they have that 6 months rainy day emergency fund put away? Because again, the money you invest in syndications, kind of long-term money. So the 506B requires that the investor kind of have a conversation with me, 1 or 2 conversations, where we kind of cover all this. And it's not that I'm nosy or I'm trying to judge anybody. It's just really, one, the law requires that I only let sophisticated investors in, and I have to kind of go through some query process to determine that. But also, I don't want people investing in deals that really aren't suitable for them. And so you kind of have this conversation, you have a discussion, you're honest with the people. And if they then decide to invest, they can go as 506B. So most of the deals we do, since we're smaller syndicators, we do 506B. Minimum investment's $25,000, so it's accessible for a lot of people. And to me, real estate's been great to me, and I know it's going to be a benefit to anybody who invests in it consistently over a period of time. So in my mind, why not help? And often they're younger people, but they don't have to be younger people, but help people who work hard for their money. They're not accredited yet, but hey, how about helping them get there by building their net worth and income by investing in real estate over a period of 3, 5, 7, 10 years? And so we actually kind of like it. We can't advertise it, so it has to be with a prior relationship. So we keep in contact with our investors, provide educational material, and that's how we kind of do it. So those are the two types of syndications you'll find. There is also kind of a crowdfunding platform, and that could maybe be something like Realty Mogul or some other ones where I think it's Reg A. I don't do it, so I don't really know it, but the crowdfunding platforms allow people to invest $1,000 in a deal, $5,000 in a deal. So it's kind of a different setup. We don't do that, but there are crowdfunding sources that people could look at if they want to get in. And Realty Mogul is one that's been around a long time, not recommending one way or the other. And we'll just give the disclaimer, we're not financial advisors, we're not CPAs, we're not attorneys, we're providing educational content, and, any investment, you should consult with your appropriate professionals. But so crowdfunding is the other way where people can get in with a little bit less money.
Understood. And before we step too far out of the LP realm, you had mentioned previously some tax advantages. What else would the LP have access to as they invest in a somewhat passive environment?
Yeah, great question. And a lot of people do. Well, so what I always tell people is, bottom line, we pay taxes on every dollar we ever make. Just the way it is. I'm not complaining. It's the way it is. I will say real estate is one of the most tax advantage investments around, better than stocks and bonds, better than a lot of things. And that generally relates to the ability to depreciate the property, which basically creates a paper loss. It's not money out of your pocket. It's not cash flow out of your pocket. It's kind of a paper loss that allows people to reduce their tax liability. So in syndications or joint ventures, they're what's called a pass-through entity. And basically what that means is whatever the property does, income, expenses, deductions, depreciation, whatever the property does, that income and expense is passed through proportionately to the investor. So if you're a JV investor and you own 10% of the deal, you get 10% of the net profit or loss. Similarly, in a syndication, if you own 5% of the syndication, you get 5%. So it's a pass-through entity, so investors in either obtain the same tax benefits as if they own the property by themselves. It's no different. The tax advantages just pass through, and it's the same thing. Taxes are a little tricky, but in general, buying real estate will help reduce your tax liability a little bit.
Awesome. And we really appreciate that breakdown again. We appreciate all the information today.
Sure.
So to that point, to kind of go 180 here and talk about kind of the general partner, the GP route, can anyone be a GP in a syndication?
Yes, there's no such thing as a GP license, so anybody could hang out a shingle and say they're a GP. So yes, anybody can be a GP. One, you got to go find the property. You got to kind of convince the broker you can actually buy it. And then, of course, you have to find investors who believe in you and are willing to trust your capital with it. So the typical kind of evolution is somebody may be at their W-2, they have an interest in real estate, they're willing to spend some time outside their 40-hour work week, tracking down properties, talking to brokers, talking to lenders, trying to find deals, at the same time talking to investors. And so typically the first deal or two, as a general partner, your best source of capital, your best source of investors is people in your social sphere, friends, family, work associates, because they know you. And if they believe you are a person of character and integrity, and they believe you're a smart person and you kind of know real estate, they're probably willing to give you a chance and invest the money. Somebody who probably doesn't know you maybe be a little less likely because you don't kind of have a curriculum vitae or track record. So typically most people start a little bit smaller deals, raise money from friends, family, and work associates. Then as they work deals, they kind of gain a level of street credibility. They can go, yes, Mr. Smith, we bought this 12 units or 20 units over here a year ago, and we've already increased rents from $1,000 a unit to $1,400 a unit. And here are pictures of what it looked like when we bought it, and here are pictures of what it looks like now. So you can gain some credibility, expertise, some experience, and then that allows you to kind of scale up. The other thing to kind of note is the way the compensation is structured for a general partner, almost all of it is backloaded. It's paid upon sale of the property, paid as a share of the profit. And so if a deal takes 5 years from purchase to sell, as a general partner, you're not going to really receive much income during those first 5 years. So you either need to have savings to live on or maintain your W-2 and maybe slowly transition. And so then as you maybe get 3 or 4 deals under your belt, and 1 or 2 are starting to go full cycle so you can sell, now you kind of get the payoff for that hard work over those 4 or 5 years. And then maybe you could transition out totally from your W-2. But people should just be aware, general partnership compensation is generally 80-90% of it's paid at the end of the deal. You get a little compensation up front, but that's basically to pay the bills, to pay for your marketing, legal fees, and all that. So the real payoff's when you sell it. So people can become GPs, but just understand it doesn't mean 6 months later they're going to get a check for $100,000. It takes a little longer than that for it to happen.
For sure. And is there a potential payout that GPs should be looking for when they're scanning for deals? Obviously, the goal of the deal is to obviously benefit your LPs because that's what keeps them rolling in. But is there a way to kind of ensure that they're going to get a certain level of profit by the deal?
So there are so many factors outside the operator's control. And just to run off a few, the Federal Reserve Board, what interest rates are, what cap rates are, what the national economy is, what the state economy is, what the local economy is, what's the geopolitical situation. So there are a lot of factors that impact the real estate market that the operator, the general partner, also known as the sponsor. If you hear the term sponsor, that's basically the general partner. A lot of factors that are outside control. So most of these deals, you kind of do 5-year pro formas. You kind of start with where the rent is now, what the expenses are now, what you can do to improve the property and increase the rents, increase the net operating income, which then theoretically will increase the value. And so you kind of do these projections, and you try to use your best professional judgment. But the truth is, I don't have any idea what the world's going to be like in 5 years. What I can tell you is, from being in the real estate market since 1978 to today, I think that's 46 years, I can tell you the overall curve of real estate is up. And I think if forget all the numbers and the graphs and all that, I would just ask people a simple question. Does anybody believe the price of housing is going to be lower 5 years from now than it is today? I don't see any way you could make any logical arguments about that. So the overall trend of real estate is up. And typically what I kind of seen is you have 5 or 6 boom years, maybe longer. You have a year or two where it kind of declines, but the decline is minimal compared to the run-up. Then maybe you have a year or two of flat, and then it starts the next run-up. So as a general partner and as an LP investor, if you invest in a good market, you invest where population and jobs are growing, and you operate the property professionally, and you structure the financing in a prudent manner, and maybe some of your listeners have heard of some syndication deals that have gone into trouble, and they almost invariably involve floating rate debt, which for a homeowner, it's adjustable rate mortgage. So these guys got floating rate debt. They had high leverage, 80 to 90% on the deal. Often they weren't local, so they didn't really have eyes on the property. And so, yes, some of those deals are in trouble, but the overwhelming majority of the market in multifamily is solid. And the way we do it, we get fixed rate debt, long-term, 5 to 7 years. We maybe borrow 60, 65%. We have cash in the bank as reserves when Murphy's Law strikes. And we know what we're doing because we have quite a bit of experience. And so I can't guarantee what the profit's going to be. I can't promise. It's just my life experience knows if we buy this property now, in 5 to 7 years, it's going to be worth more. So I don't have any other answer to that. When you do out the pro forma, you kind of estimate a final sales price, and that's based on your estimated NOI and also your estimated cap rate at sale. So you could see the total profit. So you can kind of pencil out what the general partner share is. Could be more, could be less. You just got to live it out and see what happens. So, but I think if you go about it in the right way, you're stacking the deck in your favor. You're moving the odds in your favor. And ultimately, you're going to be okay. Through my career, the only people I've ever really seen get hurt in real estate are people who over-leverage the property, minimal equity, didn't have cash reserves, so on a single family house, if the roof went, they didn't have money to pay the roof or whatever it happens to be. And maybe they didn't really know how to professionally operate the property. And then they had to sell in a down market. Those people can get hurt. But as long as the property's cash flowing, you got cash in the bank, you got fixed rate debt, if the market's down a little bit, who cares? We're not selling. And that's what we've seen the last year or two. The value of some of our assets has dropped a little bit, but are we concerned? No. They're still generating cash. We're paying our investors. We know they'll go back up. And so we're just riding it out long term. So that's how we kind of approach it.
That's awesome. We appreciate that. And kind of as we're on the back end here, just a couple items to finish up. If someone's sitting on the edge of their seat, really wanting to get involved in the syndication world, do you have any content or education to kind of help them move in that direction?
Yes, they can always reach out to me. Happy to talk and kind of point them in a couple directions. There's a great basic starter book, Best Ever Syndication book by Joe Fairless. I think podcasts like you guys are doing is a great way. When I first made my transition from single family to multifamily, I consume podcasts. There's a lot of great podcasts out there. And then there's usually conferences all over the country. So I would encourage you, if people want to get into multifamily, go to one or two conferences. They're usually 2 or 3 days long, and there'll be speakers and presentations, but also in the hallways between the presentations, you'll meet other investors and you could develop other relationships. So that's how I would kind of approach it. I am trying to launch a multifamily coaching program. I haven't quite got it all together yet, but if anybody ever wants to listen out to me, I'm happy to give them a chat and kind of point them in the right direction.
For sure. And building on that, if someone wants to reach out to you directly and learn more for you or get involved with your company, where can they look to find you?
Yeah, thanks, Drew. So I'm very active on social media, either under my name, Arn Cenedella, or the company name is Spark Investment Group. Website is investwithspark.com. And there is a lot of educational material on the website. I probably got 50, 75 blogs. So that's the best place to get me. And I'm very active on social media. It's a great way to learn. It's a great way to network with investors and find deals too. So that's the other thing. If somebody's in Lubbock, Texas, get involved in social media. Let people know what you're looking for. And you never know, but somebody may bring you a deal and that will be your start.
For sure. Yeah, you definitely have plenty on your website as well as LinkedIn. You seem to be pretty involved there. I'm always seeing updates on that stuff. So
yep, yes, I try to put some good content out. So I appreciate you noticing that.
For sure. Yes, sir. Well, like I said, I know we're limited in your time. We've been blessed by all of the information you've had to present today. So we really appreciate you coming on to provide that. We really
appreciate you having me on, and let's keep in touch. I'd like to follow you guys and see where you are in the next year or two. And if you need any help or counsel when you're looking at some deals, happy to give you my 2 cents worth.
Yes, sir. We appreciate it.
Okay.
Thank you.
Thanks, Drew. Yep. Thanks.
Okay.